The markets are currently closed as it is Sunday, December 14, 2025, but the closing data from the last active session on Friday paints a picture that demands your absolute attention. Carvana Co., trading under the ticker CVNA on the New York Stock Exchange, closed the week at exactly $455.68 USD. That represents a significant intraday decline of 17.05 USD, or a 3.61% drop for the session. Now, if you were just glancing at your brokerage app or checking a quick notification, seeing a stock down nearly 4% might trigger that instinctive sell reflex, or at least a moment of hesitation. You might be thinking the rally is over or that the gravity of valuation is finally catching up to this high flyer. But here's the reality that the headline number obscures. This pullback might be the single most deceptive signal in the market right now. While the retail crowd sees a red percentage and assumes weakness, the institutional machinery is likely viewing this as a final clearing event before a massive structural catalyst hits. The expectation on the street is that Carvana is just a volatile, interest rate-sensitive used car retailer that had a lucky run. The reality, however, is that we're staring down the barrel of a forced buying event that could fundamentally alter the stock's supply-demand dynamics in a way that very few individual investors truly understand. We're talking about the S&P 500 inclusion effect, and if you aren't positioning for what happens when the passive index funds, the Vanguards and Fidelity ETFs of the world, are legally mandated to buy millions of shares, you're missing the forest for the trees. Let's break this down with the nuance it deserves, free from the noise of panic selling. The drop to $455.68 USD isn't just random noise, it coincides with the specific narrative taking shape. We saw news that Carvana's COO, Benjamin Houston, sold about $9.5 million worth of shares recently. On the surface, insider selling looks bad. It looks like the people at the top are cashing out while you are buying in. That is the common expectation. Insiders sell, stock goes down. But look closer at the transaction. This was a pre-arranged 10b5-1 trading plan, and he also exercised options to acquire more stock. The net result isn't a lack of confidence, it is standard executive compensation management. However, the market's knee-jerk reaction to insider sells headlines often creates these temporary dips which sophisticated capital pools use to accumulate shares at a discount. Think about the sheer magnitude of what Carvana has achieved to get here. It wasn't long ago that this company was priced for bankruptcy. The narrative was that they were burning cash, their debt was insurmountable, and the business model of selling cars online was fundamentally broken. Critics said they were just a tech wrapper on a low-margin business. Fast forward to today, and the reality has completely shattered those expectations. They haven't just survived, they have orchestrated one of the most aggressive operational turnarounds in modern corporate history. They are profitable on a GAAP basis, they have restructured their debt, and now they're being welcomed into the S&P 500, the most prestigious equity club in the world. This inclusion, effective around December 22, means that every single S&P 500 index fund, every pension fund tracking the benchmark, and every Schwab Intelligent Portfolios algorithm tracking large-cap blend strategies must buy CVNA stock. They don't have a choice. They cannot look at the valuation and say it's too expensive. They have to buy to match the index weight. When you look at the trading volume from Friday, sitting at around 6.2 million shares, it's elevated but not panic-induced. It suggests a battleground. You have traders taking profits after a massive run-up. Remember, this stock has more than doubled recently, clashing with funds that are slowly building positions. The volatility is high, with the stock swinging between $455 and $485 in a single session. That's a $30 range. For an active trader using Interactive Brokers trading platforms or even just managing a small account on Robinhood, this kind of movement is terrifying if you're on the wrong side, but it's an absolute goldmine if you understand the support levels. The stock found support right around that $455 level, which is crucial. If it holds here, the setup for the next leg up is technically pristine. Now, let's talk about the business itself, because the online used car salesman tag doesn't do it justice anymore. Carvana has effectively built a vertical logistics infrastructure that rivals what Amazon did for general retail. They don't just list cars, they own the reconditioning centers, the transport network, and thanks to the ADESA acquisition, a massive footprint of physical auction sites that puts them within miles of a huge chunk of the U.S. population. This is the moat that people missed. The expectation was that anyone could build a website to sell cars. The reality is that no one else has the physical infrastructure to inspect, recondition, and deliver a car to a customer's driveway as efficiently as Carvana can right now. This operational efficiency is showing up in their GPU, or gross profit per unit. They're squeezing more profit out of every single car sold, not just by charging more, but by lowering the cost to get that car ready for sale. This brings us to a critical comparison. When you look at high-growth darlings like Nvidia stock or Tesla stock, the early arguments were always about valuation. It's too expensive, the bears would say. But in platform businesses, operating leverage is everything. As Carvana sells more cars, their fixed costs don't rise at the same rate, meaning their bottom line explodes upwards once they cross a certain volume threshold. We're seeing that happening right now. They recently reported record third-quarter results with net income of $263 million. That's real GAAP profit, not some adjusted fantasy number. They beat revenue estimates by over $500 million. This is why you're seeing analysts at Jefferies raising their price targets to $550. They are seeing the math work out in real time. However, we need to be realistic about the risks, or we're not doing our job as analysts. The used car market is notoriously cyclical. It's tied to interest rates. When rates are high, financing a used car becomes incredibly expensive for the average American. If the Federal Reserve signals a higher-for-longer stance, or if we see a tick up in consumer loan delinquencies, Carvana is right in the crosshairs. They also have a significant amount of debt despite the restructuring. It's a cleaner balance sheet than before, but it isn't pristine. You need to watch the 10-year Treasury yield as closely as you watch the CVNA ticker. If yields spike, CVNA will likely take a hit. This is why diversification is key. You wouldn't put your entire life savings into just one name. You'd balance it with stable exposure, perhaps through Fidelity mutual funds or a broad market ETF in your SoFi Invest account. But as a high-octane growth component, the thesis is strong. I want to pause here and get a sense of where you stand on this stock. The psychological gap between the bears and the bulls on this stock is wider than almost any other large-cap name. Comment below with your honest take. Do you think the S&P 500 inclusion is a sell-the-news event where the stock crashes after the funds buy? Or is this the start of a run to $600? And also, if you're holding, what is your cost basis? Seeing where everyone entered this trade is always fascinating. Let's shift gears back to the technicals and the institutional flows. We mentioned the S&P 500 inclusion, but we need to discuss the short squeeze potential. Carvana has historically been one of the most shorted stocks on the market. Short sellers, people betting the stock will crash, have absolutely been decimated over the last year, but there's still a significant short interest float. As the stock price rises due to index fund buying, these remaining shorts face a nightmare scenario. They have to buy stock to close their losing positions, which drives the price up further, which forces more shorts to cover. It's a feedback loop that can send a stock parabolic. We saw shades of this with GameStop years ago, but this is different because Carvana has the fundamental earnings to back it up. It isn't just a meme, it's a growth engine with a technical powder keg attached to it. Consider the broader ecosystem of online investing. Platforms like Robinhood and SoFi have democratized access to these kinds of narratives, but they also amplify the volatility. When you see a 3.61% drop like we saw on Friday, a lot of that is algorithmic trading and retail stop losses getting triggered. The weak hands get shaken out. The smart money, the institutional allocators using Fidelity Wealth Management Services or Interactive Brokers accounts, often have buy orders sitting at these support levels. They're waiting for you to panic so they can buy your shares cheap. The volume analysis suggests that while there was selling pressure, it wasn't a total capitulation. It was orderly. That's a sign of a healthy correction within an uptrend, not a trend reversal. Furthermore, we need to look at the macroeconomic backdrop. The used car market has been normalizing after the insanity of the post-pandemic supply chain crunch. Prices of used cars have come down, which you might think is bad for Carvana, but it actually helps them. Lower prices mean more volume. It means more people can afford to buy a car. Since Carvana makes a steady margin on every unit sold, they care more about volume velocity than record-high car prices. If they can sell 200,000 cars a quarter at a reasonable price, that's far better for their long-term health than selling 100,000 cars at inflated prices. Their recent guidance suggests they're